but where do we go from there? Manishi Raychaudhuri of BNP Paribas with us now. Morning, Manishi. Good to see you again. Do you think there's a last gush left before the year is out, globally and locally?
I think, as far as the last few days of the year are concerned, I think there are two things likely to happen. Firstly, the market is likely to move in a range which it has kind of marked out for itself, which is, somewhere in the range of 15,500 to 17,500. Partly because many of the investors, both long-onlys and hedgies, are unlikely or possibly unwilling to take fresh positions at this point of time. This is something we gathered over the last 2.5 weeks. We were traveling all across the United States, Middle East and Europe. And I think, for the time being, people would just sit on their positions, just watch how the economic fundamentals pan out to be, and really make a decision towards the beginning of next year. So I'm not really expecting any sharp movement over the next few days or so.
Manishi, morning. What about stepping into next year though? Because the interesting thing is some of your peers are calling for intense volatility, a range as wide as 13 to 20. What is your working target for the next year?
Difficult to say. I agree with that 20 number. In fact, we ourselves have a target of 21,000 for the Sensex towards the end of 2010, which is a little more than 1 year down the line. But the question is that before it reaches 21,000, whether it would dip down, and if the market does correct, to what extent it would dip down. And that, I think, is a very difficult question to answer at this point in time. If you look at the valuations and kind of try to relate them to what's happening on the earnings growth side, the market is clearly in some kind of a no man's land. It's trading at about 17 times PE right now, which is somewhere close to mean plus 0.5 standard deviation. And earnings growth in fiscal 10 is likely to be kind of flattish. It would possibly be about 4 to 5%. So we have about 2 flat years, fiscal 9 and fiscal 10, which are in the range of 2 to 5%, before an acceleration in fiscal 2011. Now, the question is, at what stage would the market take into account that acceleration? I think it has partly already taken into account. The extent of outperformance that we have seen is possibly reflective of that. At the same time, there are certain fundamental economic variables which could put pressure on the market in the near term. For example, some of the large economic stimulus that we have seen over the last 1.5 to 2 years, at some stage they would have to be withdrawn. For example, the excise duty cuts that we have seen, partly they could be rolled back. Secondly, I think even the Reserve Bank of India would have to at some stage exit out of these loose monetary situation. Now, if interest rate increases are driven purely by growth, then that's not a major concern for the equity markets. But I think initially it could lead to some degree of underperformance as far as the equity markets are concerned. And, whether that happens in the first quarter or in the second quarter, we don't know at this point in time, but it'll possibly happen sometime in the near future.
Where is the floor for this market, Manishi? Because in the last fall, we stopped at 15K, and a lot of people believe that 15,000 is the new 12,500. That's the floor which will see a lot of buying and the market will not dip below that. Do you agree?
Right. Honestly, it's a difficult, almost impossible question to answer. If you look at last 15 years history, the absolute floor in terms of valuation is a 9 times PE. Now I don't think we're really going back to a 9 times PE in the near term. If the market does go back, then it's possibly somewhere around 10 to 11,000. But I don't think that's really possible in the near term at least. So, I don't know, my guess would be somewhere in the middle of that range. Currently we're at 17 times. If the absolute bottom is at somewhere around 9 to 10 times, maybe somewhere around maybe 13 to 14 times the market could bottom out. But as far as near-term calls in the market are concerned, it's almost like throwing a dart. What I can say is that we shall not possibly be testing those, the previous lows that we have seen over the last 6 months to 1 year. That seems very clear, because the kind of expectation about economic growth that we had, that has clearly moved up now. it seems that even in fiscal 10, we may end up with somewhere close to 7%, which would possibly accelerate further in fiscal 11, primarily driven by IIP growth, which would in turn be driven by infrastructure and corporate capex. So clearly we are unlikely to see those historic lows. And I think, somewhere around 14 to 15,000 is a good time, as far as long-term investors are concerned, to be considering re-entering this market again.
Just to scratch on the point of liquidity though, Manishi, is it your understanding as well that a large part of this liquidity has taken the form of ETFs, and might that cause more volatility for the market?
To some extent, yes. But I think, as far as volatility is concerned, that is almost turning out to be a fact of life all across emerging markets. And one word about liquidity, if we look at both FII flows and domestic flows, I think both of these are still kind of understated. We have seen about $15 billion of FII flows into Indian market. If you look at Asia ex-Japan investors and global emerging market investors, they are possibly just about neutral to overweight India. Their overweight positions compared to the benchmark would possibly be just about 0.5% or so. But in reality, I think both these classes of investors would like to own more of India, because in the foreseeable time horizon, India is one of those 5 or 6 economies in the world which would contribute to global growth. There are not too many economies where you can actually get growth at this point in time. So, and the second factor to be considered is that I think the emerging market currencies, including the Indian currency, the rupee, is likely to appreciate in the near future. Partly the reason being stronger growth in this part of the world, and secondly also the fact that interest rates would possibly rise in the emerging markets, while in the developed market they would remain flat. There's not much of a change. So the carry trade would continue to work. If you put these two factors together, then I think liquidity, particularly foreign liquidity, is going to rise, and domestic liquidity will continue to be driven by the relatively high domestic savings rate. So on the liquidity front, we are not really seeing any major problem at this point in time.
Manishi, which of these two stocks would you buy now, Tata Motors or Suzlon?
Actually we don't have buy recommendations on either of these right now. For Tata Motors, for example, we do understand that the domestic business is recovering quite a lot. There are certain, tailwinds as far as their international business is concerned as well. But at the same time, I think the stock price has more than adequately captured these upsides. And I think for Suzlon, the real recovery is kind of pushed out into late 2010 or early 2011. As far as order flows into the wind energy sector is concerned. So we don't have any of these in our model portfolio, to be frank.